Good morning. Today we're diving into the world of finance, but in a way that's easy for everyone to understand. We're going to talk about something called a synthetic put. It might sound complicated, but I promise we'll break it down together. Think of it as a clever way to copy a simple options trade using different tools. A regular put option is a contract that gives you the right, but not the obligation, to sell a stock at a set price. It's a bet that the stock's price will go down. The synthetic put achieves the exact same goal, but it does so by combining two different actions: shorting a stock, buying a call option. It's a strategy used by traders who want the benefits of a put option but with a different structure. So, who exactly uses this strategy? It's often favored by experienced traders who might have specific reasons for avoiding a standard put option. For instance, some markets for regular puts might not have enough buyers, sellers, making them difficult to trade efficiently. This is known as poor liquidity. In such cases, a trader might find it much easier and cheaper to short the stock. Buy a call option instead. It's also a tool for traders who are managing a larger, more complex portfolio. They might use a synthetic put to fine-tune their market exposure, hedge other positions they hold. When we talk about making money from trading, it generally falls into two main categories: income capital gains. Income strategies are like earning a regular paycheck. They aim to generate small, consistent profits over time, often by collecting premiums from selling options. Think of it like being a landlord and collecting rent. On the other hand, capital gains strategies are about buying low and selling high, or shorting high and buying back low. The synthetic put strategy falls squarely into the capital gains category. You are not trying to collect a small, steady income from this position. The entire purpose of a synthetic put is to profit from a significant downward movement in the underlying stock. You are making a directional bet. You believe the stock is overvalued and due for a fall, and you position yourself to capture profit from that decline. This is not a set-it-and-forget-it trade. Instead, it requires you to be correct about the stock's direction. Your profit is directly tied to how much the stock's price decreases. The more it falls below your entry point, the more you stand to make. This is a speculative play on an asset's depreciation. Every trading strategy has a market condition it prefers, and the synthetic put is no different. This strategy is unequivocally bearish. Bearish is the term traders use when they believe the price of an asset, like a stock, is going to go down. The entire structure of the synthetic put is designed to make money when a stock's value falls. If you are optimistic about a company and think its shares are about to soar, this is absolutely the wrong strategy to use. It would be like opening an umbrella on a perfectly sunny day. It serves no purpose and works against the prevailing conditions. The synthetic put is your financial umbrella for a rainy day in the market. Let's break down the two components to see why this is. The first part of the strategy is shorting the stock. Shorting, or selling short, is an inherently bearish action. It involves borrowing shares of a stock from a broker and immediately selling them on the open market. The hope is that the stock's price will fall. If it does, you can then buy back the same number of shares at the new lower price and return them to the broker. The difference between the price you sold them for and the price you bought them back for is your profit. This action alone is a direct bet against the company's success in the short term. The second part of the strategy is buying a call option. Now, buying a call option on its own is a bullish move, a bet that the stock will rise. So why do we include it in a bearish strategy? Volatility is a word we hear a lot in finance. It measures how much a stock's price swings up and down. Some stocks are calm and trade in a narrow range. Others are like a roller coaster with wild price movements. For a synthetic put, you want volatility to increase. Specifically, you want that increase to have a downward bias. But the initial setup works better when implied volatility is low. Sounds contradictory? Let's unpack it. The strategy has two parts. Volatility affects each part differently. First, the call option you need to buy. An option's price, its premium, is driven by implied volatility. To make this all feel a bit more real, let's use a company we all know, Procter & Gamble. Ticker, PGP&G, is a giant in the consumer goods world. Tide detergent, Crest toothpaste, it's generally considered a stable, reliable company, a blue-chip stock. This stability means it usually doesn't have wild price swings. That's why it's a good example. Imagine a trader thinks P&G will face headwinds. Now that Jane has her plan for Procter & Gamble, it's time to act. Entering a synthetic put trade involves two simultaneous transactions. The first, short the stock. The second, buy the protective call option. It's crucial both parts execute at roughly the same time. Most brokers let you place a single combo order to do that. That avoids executing one leg and the market moving. Let's walk through Jane's exact steps with PG at $170 per share. Step 1. Short the stock. One options contract equals 100 shares. Jane places an order to sell short 100 shares of PG at $170. When filled, her account is credited with $17,000. 170 times 100. That's borrowed proceeds, not hers to keep yet. She now has an obligation to buy those shares back later. She profits if the stock falls, and she buys them back at a lower price. Step 2. Buy the protective call, executed at the same time. Jane buys one November $170 call contract. The option price is $5 per share. One contract covers 100 shares, so total cost is $500. $5 times 100, plus small commissions. That $500 is debited from her account. Time has passed, and Jane now needs to decide how to exit her trade. Closing a synthetic put position is simply the reverse of opening it. It involves two transactions: buying back the shorted stock, selling the call option that was purchased for protection. Just like when entering the trade, it's best to execute these actions simultaneously. Use a combo order to lock in the final profit or loss. The outcome depends entirely on where Procter & Gamble's price is when she closes. Let's explore a few possible scenarios for exiting the trade. First, let's imagine the best-case scenario for Jane. Her bearish prediction was correct. 2 months have passed, and P&G had a difficult quarter. The stock price has fallen dramatically to $150 per share. Jane decides it's time to take her profits. To close the position, she first needs to buy to cover the 100 shares she shorted. She buys them at the current market price of $150, costing her $15,000, 150 times 100. She initially received $17,000 for shorting them, so she's made $2,000 on the stock portion. The call option she bought is now far out of the money and practically worthless, perhaps trading for just 5 cents or $5 for the contract, so she sells it to close it out. Let's calculate her total profit in this winning scenario. Effectively managing a trade is just as important as entering it correctly. Let's return to our successful scenario. Procter & Gamble's stock has dropped to $150 per share. Jane has a nice profit on the books, but she needs a plan. One of the biggest challenges for any trader is knowing when to take profits. Greed can be a powerful emotion. It might be tempting to hold on, hoping the stock will fall to 140 or 130. While this could happen, the stock may have found a bottom and could rebound, eroding her hard-earned gains. A professional trader often sets a profit target before entering a trade. For example, Jane might have decided she'd be happy with a $1,500 profit, or she'd exit if the stock hit $150. Since the stock has hit her target, no trading strategy works every single time. It's essential to have a plan for when a trade goes wrong. With a synthetic put, your maximum loss is clearly defined from the outset. That's one of its greatest strengths. In Jane's P&G trade, her maximum loss is the premium she paid for the call option, plus the difference between the strike price and the short price, if any. In her case, the prices were the same, so the loss is capped. The maximum loss occurs if the stock price rises significantly. If the stock went to $180, her loss was around $450. If it went to $200, her loss would still be capped at a similar amount. The gains on her call option would continue to offset the losses on her short stock. Know your maximum loss before you enter the trade and be comfortable with it. Jane knew the most she could lose was approximately $500. That's the cost of her option, plus commissions. She decided that this was an acceptable amount of risk for the potential reward. This is a critical psychological step. By accepting the potential loss beforehand, a trader is less likely to make emotional decisions if the market moves against them. Panicking is the worst thing you can do, so this is it. Try it out, but be careful. Good luck with your trading and see you next time.